Chapter 15, Financing 2, the final chapter on financing and mortgages. So this chapter is going to discuss primary and secondary markets, which I've already explained to you really, but there's a lot more in here too. So in this chapter, we're going to talk about the various financing techniques, identify the sources of real estate financing, where the money comes from. And even though we've already discussed this in the last chapter, explain government influence on mortgage lending. And I've kind of already discussed that with you as well in the last chapter. I believe financing one and two, these chapters should be combined. It makes it a little bit too much here. So, how does lending work in a nutshell? Well, the bank lend their depositors money, even though technically we've learned that that's not really the fact. But banks lend their depositors money with the intent of reselling those loans and getting the money back, plus some interest, plus they charge a servicing fee. So for doing the collections and rendering accounting to the investor who then buys the loans. Most lenders do not are not portfolio lenders that lend their own money and generally don't resell their loans. Most lenders resell them. Loans are originated in what is deemed the primary market to consumers to purchase real estate, and then those loans are resold to investors in what is called the secondary market. So the primary market sources of lenders to borrow money are mortgage bankers, mortgage brokers, and credit unions. Fannie Mae is the largest purchaser of loans in the secondary market, and it's estimated they buy one out of every 10 loans that are originated to buy real estate. That's a lot for one company, right? One out of every 10 loans in existence. Think about all the lenders that are out there. Ginnie Mae, well, they got the same last name. That's Fannie's ugly stepsister. Why do I say that? Well, because she buys those ugly loans. You know, the ones written to people with less than perfect credit, the riskier loans. Okay. So Fannie Mae and Ginnie Mae. Fannie Mae is the largest purchaser of loans in the secondary market. Ginnie Mae, her ugly stepsister, is the one that purchases those risky loans. Um, and then we have Freddie Mac. Freddie Mac purchases conventional loans. I know. Portfolios lenders rate conventional loans, right? So they plan on not reselling them. They plan on keeping them within their own investment portfolio. So sometimes, though, lenders and investors, they may need money for a new project. And if that's the case, they're willing to sell some of their assets, some of their loans. But who would buy the loans from the conventional loans from the portfolio lenders? Um, because they never wrote them according to any third party lender guidelines, right? They never intended to resell them. Well, Freddie Mac would, but Freddie Mac would then just analyze them on an individual basis before they bought them. Okay. So this is how lending works in a nutshell, and it actually covers a lot of notes for a lot of the things we're going to go over. So, if you want to snap picture, snap away. Otherwise, I'm changing the slide right about now. So here we go. Primary mortgage market, lenders who supply funds to borrowers. Page 285. Highlight that. See, we also have institutional lending. You know, you get loans from savings and loan associations, the banks, commercial lenders, those are those private investors, which include insurance companies, mortgage brokers. These are the sales reps, basically, that work with many different lenders, banks, and private investors to get loans for the consumer. We call them mortgage brokers, which are different from mortgage bankers. Mortgage bankers, those are the mortgage reps that work only for the one lender and usually only deal with their products. Credit unions, the nonprofit banks, and pension and trust funds, like the firemen's, the teachers, the police pension funds. Sometimes they invest that money to pay those pensions out eventually. And for the unions themselves to make money, I guess. Boom. Application for credit. How does that work? You may want to snap a picture of this slide. It is nowhere here in this book. I write the process from the beginning of a transaction to the end. How do we go about getting financing? Well, the first step is you get a pre-qualification letter from a lender, right? What's required to get that? A quick credit score check and to determine what your credit looks like, what your history is of paying back loans and such, to determine what the maximum amount the borrower could likely qualify for, and the borrower states verbally their income and debts, but it's unverified at this point. Your income, debts, and your assets. Yeah, let me write that in there too. Let's get it. Let's get it correct. Your income, debts, and assets. Verified at this point.
I have a question.
Shoot.
Yeah, the changes you made in the class, in the slides you showing us, the changes.
To save them all, I'm going to upload all the newer ones. Is that
Okay. Okay. Thank you.
Gotcha. Yeah, I usually do that. I usually do it at the end of each day. Actually, but I haven't yet for this class. So thanks for reminding me. I'll update them all. I'll update them all. And you guys do have your class links playlist, right? All right.
Mm.
That class links playlist for these recorded classes. I'm also going to add that link for your class to the class links Word document. Right at the beginning of that, I have a list of all of the previous classes that I've taught, links to their playlists. So I'll add yours there too. It'll be right at the top. Okay, the latest ones will always be up top. All right, and then we have the loan pre-approval letter. So it goes from pre-qualification letter then to loan pre-approval letter, where now all the information that was given for the pre-qualification letter is now verified because they've shown bank statements and pay stubs and tax returns and such. So now this is all verified, and then the lender will issue a loan pre-approval letter. So the next step is even to get the loan pre-approval letter, who's it getting verified by? They've been verified by the lender's underwriter. An underwriter is somebody who works for the bank or lending institution that examines all of the documents and determines risk. That's their job. Very exciting job. I know a girl that does this for one of the banks. So underwriting is the process by which an underwriter examines risk to the lender. Process performed by an underwriter to examine risk to the lender. That's worded weird. So underwriting. This is the process performed by an underwriter. I'll just say, who examines risk to the lender? Who examines risk to the lender? Oh, I got something here. So, so the process from which the lender carefully investigates the applicant's financial information, and info about property to determine if they will grant a loan. The lender examines all the borrower's information, the approval of borrower process. They look at your finances, your income, your expenses, your debt to income ratio, credit history, and we should also add their assets. Right? To determine the risk for the lender. They examine the property information, the approval of property being financed. How do they do that? Well, through an appraisal. That's an estimate of value of the property. Wood destroying insect reports and certificate of occupancy and fire inspections if required by the municipality, which majority of them do. Then the lender's going to want to see all that. And then once that underwriter, through the underwriting process, determines that the juice is worth the squeeze, the risk is acceptable, they'll issue a loan commitment letter. So a commitment letter is issued after the borrower completes a loan application, submits their financial info, which is then verified, and the property appraisal and inspection report. If underwriter decides to grant the loan, a mortgage commitment letter is given. The lender is committing to grant the loan. This creates the contract with the borrower. All right. Okay. So this in the book. The book doesn't go over in as a much straightforward detail explanation like I said here. So we'll highlight this. Through the process of underwriting, the lender carefully investigates the applicant information, studying credit history, how timely the applicant has repaid debts, credit reports, and appraisal of the property before deciding whether to grant the loan. The lender's acceptance of the application is written in the form of a loan commitment or commitment letter. That's what we refer to it as. And this is one of the fields on the sales contract that we fill out. When the buyer has to produce the commitment letter by from the lender. Everybody got that? Let me know when you do.
I got it.
Okay. When lenders run credit scores, there's three major credit reporting agencies. They don't average them out. They just pick whichever number's in the middle. Boom, that's your credit score. It's not that scientific now, is it? Those three major credit reporting agencies are Experian, Equifax, and TransUnion. Now, qualifying ratios. Let's do this. Let's highlight the title, Qualifying Ratios, on page 287. And let's write this definition next to it. It's about 3 lines. If you write small enough, you could fit it there. An example of a qualifying ratio is a DTI. That stands for debt to income ratio. It's used to determine the maximum monthly expense for housing a borrower could afford to pay. PITI. That's your maximum monthly expense for housing, the PITI, right? Now, I wrote in my notes up here in my explanation, I wrote that sometimes 48% is permitted. It depends on the lender. The industry standard is 28.36, but some lenders could accept up to 48%. That's kind of stretching the buyer's money there. That's kind of risky. That's getting a little risky.
I got it.
Okay, so this home buyer's guide that I mentioned here, once again, let me correct this. This is actually is not. I assumed it was coming from the Real Estate Commission because I think I got it. I think I found it on the Real Estate Commission's website somewhere, but it was actually developed by the NJDOBI. That's the New Jersey Department of Banking and Insurance. They put together this home buyer's guide. If you guys recall, I showed it to you the other day. As I gave you guys 3 home buyer's guides, and that was this one here. Everything you want to know about buying a home. And so they go over searching for a home, and then getting a loan, doing the home inspections, the closing process, and all that stuff. So let me get to that point where here we go, DTI. All right, I got some screenshots from this, and I think I put it on the next slide. Yeah, I did. So you guys got this note here? Everybody got this written in here? Because this is the explanation you'll need to know for exam question sooner than later. Hint, hint. What are the qualifying ratios used by lenders to determine the maximum monthly expense for housing a borrower could afford to pay? Pity. And what's an example of a qualifying ratio? The DTI, the debt to income ratio. So, and here's a screenshot I got from that home buyer's guide. It's not the NJREC, it's from the DOBI. So as you can see, the debt to income ratio, one of the first factors the lender considers when deciding how large of a mortgage loan you qualify is your debt to income ratio, or DTI. To calculate your DTI, you got to add up your current monthly debt, your credit card payments, car loan, etc. And then you divide it by your total monthly pre-tax gross income. The percentage ratio is a simple way of showing how much of your income is available still to spend, right? So therefore, you could spend that on a mortgage payment after all of your other payments are met, your long-term debts. So the lender often calls this 28.36 qualifying ratio, even though I told you that sometimes I've seen lenders allow up to 48%. So the first number, 28%, indicates the maximum amount of your monthly pre-tax gross income the lender allows for monthly housing expense. The amount will include principal and interest of the loan, your property taxes and homeowner's insurance, and the HOA fee if it's a condo, right? Or a co-op. So the second number, 36, refers to the maximum percentage of your monthly pre-tax gross income that the lender allows for all monthly housing expenses plus all reoccurring debt, like car payments and such. So if your ratio numbers are higher than 2836, you may want to consider reducing your debt, paying down some credit cards, or paying off whatever other long-term debts that you got there. When calculating and relying on your DTI to determine loan affordability, be confident with your numbers so that you don't stretch out your finances too much so you're struggling to make payments, and then stick to those numbers, okay? Now, I showed you that video, and part of that video I showed you about money as debt, if you guys recall, was explaining how the United States, we have, well, all over the world, how lending works, and how there's a central bank in most governments, right? And the central bank here in the United States, which is not part of the federal government, is called the Fed, or the Federal Reserve. Right? So do not write these notes. You guys do not need to write these notes. Okay. I'm just putting it here for informational purposes only. So to try to counter inflationary and deflationary trends, to establish economic stability and maintain sound credit conditions by altering the applicable federal rate. You ever hear that you guys ever watch financial news channels? Or sometimes you even may see it on the regular news where they talk about like the finances or the economy. They say, the president's negotiating with the Fed to see if they could hold the rates lower, or are they going to be raising the rates? We're going to find out, Sometimes that's probably the extent that most people hear about the Fed and raising of rates. What rate are they talking about? The AFR, the applicable federal rate. That's the cost of lending to the banks themselves. And then the banks themselves, if their cost for getting the money from the central bank goes up, well, then they're going to raise the rates for everybody else. So that's the rate they're talking about, the applicable federal rate, which all lending is based on. That's the Fed is the central bank here in the United States. It is not part of the federal government. It is a central bank created by Congress back in 1913 to establish economic stability, setting rates, creating new money, and a fractional lending system. Yeah, when we got off of when we got off the gold standard. The AFR is the applicable federal rate. Okay, and we learned about that by watching this video, Money as Debt, if you guys recall. The market where money is supplied to the consumer to purchase real estate, that's known as the primary market. And where those loans are then resold to investors, that is known as the secondary market. That's about probably the only notes to write in here. Okay, primary market and secondary market. Oh, you know what else? All the way down in that same section under government influence in the secondary market, in that last paragraph, I'm going to give you some stock symbols here. So, Fannie Mae, their stock symbol is FNMA. Because they used to be called the Federal National Mortgage Association. But you could still figure out that that's Fannie Mae. How? Look at the stock symbol, FNMA. Sound it out. FNMA, right? And they operate under a shareholder-owned company under congressional charter. What the hell does that mean? Congress. if you look at an old enough book, I just threw out all my really old books, so I can't show it to you anymore. But if you looked at one of the older books, it actually said a private corporation operating under a shareholder or whatever that makes the decisions. Now it's saying it's under a congressional charter. Yeah, Congress. We did all them bailouts to the point that the government pretty much owns them and is in control. So the government has to shore them up the best they can and try to sell it off again, our interests, so that it's no longer owned by we the people, because we the people should not be in the banking business. You ever hear some politicians saying that? Usually that's like Rand Paul. He's usually all over the talking about banking and finances and how the government shouldn't be involved in this stuff, that the government takes on too much of a role in the private sector stuff, you know. Banks should either sink or swim on their own. They should not be propped up by the government. So the largest purchaser of loans in the secondary market is Fannie Mae. They buy one out of every 10 loans in existence, making them very influential. So most lenders, local lenders, when they write a loan, they write it with the intent of reselling it to get the money back, so, plus some interest, and maybe even get a servicing fee for rendering accounting and doing the collections still. So when Fannie Mae changes their lending guidelines for the loans that they're willing to buy, those local banks, they usually change their lending guidelines to match Fannie Mae's guidelines for the types of loans they're willing to buy. So they have a lot of influence there. They got a lot of pull. Loans that Fannie Mae is willing to buy are called conforming loans. So those guidelines for the types of loans they're willing to buy, if a loan meets those lending criteria, they're called conforming because they conform to Fannie Mae's lending guidelines for those loans they're willing to purchase. Now, do not confuse them with conventional loans, which you get from portfolio lenders, because conventional loans, they don't meet anyone's lending guidelines because they're not reliant on any third party. They're not planning on reselling those loans to any third party. Ginnie Mae, Fannie's ugly stepsister. All right, that's the Government National Mortgage Association. Her stock symbol is GNMA. And you could sound that one out too. Ginnie, right? So even though it comes from its former name, the Government National Mortgage Association. And she buys those riskier loans. That's why I call her the ugly stepsister. You know, she's buying them risky loans. She's very risky there in her behavior. Now, and then we also have Freddie Mac. You're not going to remember that, or you're not going to sound out that stock symbol. It's FHLMC. It's because they used to be called the Federal Home Loan Mortgage Corporation. Okay, and they purchase conventional loans from portfolio lenders when and if they look to get any of those off of their books. Okay, so here we go. Highlight that. Loans that meet Fannie Mae's guidelines are called conforming. That's on page 288 under second paragraph, like you can see here, under Fannie Mae. Loans that meet Fannie Mae's lending guidelines are called conforming loans. And on the next page at the top, Ginnie Mae, I just wrote above that, that's Fannie's ugly stepsister. All you need to know is that they're related, because they give some kind of stupid questions sometimes on exam about which one of these lenders are related, you know. And they show Fannie Mae, Ginnie Mae, Sallie Mae. Don't say Sallie Mae, because what was that, for student loans? Fannie Mae, Ginnie Mae, Sallie Mae, and Freddie Mac. Okay. Mac doesn't have the same last name, but Sallie Mae does. But Sallie Mae is not related because Sallie Mae is using that's for student loans. That's the government program for student loans. All right, everybody got that? All right. So non-conforming loan is one that does not meet Fannie Mae's lending guidelines. If a conforming loan is one that conforms to Fannie Mae's lending guidelines, a non-conforming loan, therefore, that does not conform to their guidelines. Kind of simple, but you gotta know the basics that conforming and what non-conforming to figure out what non-conforming is. Okay, so those are the loans that Fannie Mae is not willing to purchase. They're because they don't conform to their lending guidelines. Portfolio lenders make conventional loans. Some people refer to them as portfolio loans and then call the lender conventional lender. Whatever, you guys get the gist. It's conventional and portfolio is the same thing. It can be flexible in their lending guidelines because they do not conform to Fannie Mae's lending guidelines necessarily. They could give loans that are conforming to Fannie Mae's lending guidelines, but they don't need to be because they're lending their own money and they're not relying on any third party's arbitrary guidelines to determine whether they're going to lend their own money or not. So they may write a loan that does just so happen to conform to their guidelines, but it's not because they were referring to those guidelines. You understand? If somebody's going to buy an expensive home, like a mansion, they're going to get a loan. Well, those Fannie Mae's lending guidelines usually match up with FHA's lending limits for homes in the different counties. Okay. So if somebody's going to buy a mansion, it's clearly going to be above that amount, right? Where do you get the loan? Where do those people get the loans from? A lot of rich people, they don't use all of their money. They're not using up all their cash to buy a house. I think some of them do, but most of them, they go and they get a loan. They use somebody else's money because they got financial advisors that say, don't be stupid. Don't use your own money. Use someone else's money. And then we could write off the interest payments on your taxes over the years as you pay it off forever. Okay. So there's tax benefits for not paying it off. Having write-offs against your income and such. So anyway, the borrower with unusual credit situation, not bad credit, or if you're buying a unique house, like a large construction project or a mansion or expensive home, you could get those loans from portfolio lenders. They're conventional loans. And it's used to purchase properties that are non-conforming. Okay, so a jumbo loan. What is a jumbo loan? Jumbo loans are non-conforming loans. They're like the loans for mansions. They're jumbo in size. It's so obvious. It's in your face. What is a jumbo loan? It's a huge loan. It's jumbo size. Okay, so I see a lot of students get this wrong on exam because they're like, that can't be the answer. It's too obvious. It's jumbo. You call them larger than those that meet Fannie Mae's lending guidelines. And then they got an answer option there, jumbo. And people are like, no, that can't be it. It's too freaking obvious. No, that's it. That's the answer. It's jumbo. Okay. So a loan larger than Fannie Mae is willing to buy. It's jumbo in size. You use that for the expensive homes, okay? You get them from portfolio lenders or also known as conventional lenders, all right? So that's a little obvious, but it fools people sometimes on exams. That's why I'm pointing it out right there. That is a correct exam answer option, all right? So we could highlight that here on page 289. Primary conventional loans. Freddie Mac has the authority to purchase mortgages. They may buy loans that don't conform to Fannie Mae lending guidelines. We're writing that in there because it doesn't specifically say that right here in the book. Under non-conforming loans, we'll highlight that first 2.5 lines there up to portfolio loan. That loans higher than the secondary market's lending limits are known as jumbo loans. They're non-conforming to Fannie Mae's lending guidelines. They're jumbo in size. And you get them from portfolio lenders. or conventional lenders and then call it a portfolio loan, whichever. Depends on who you're talking to, what they call it. Conventional portfolio, same thing. Conventional or portfolio lender, conventional or portfolio loan, same thing. Everybody got it? Right. Notes here. Okay, now we're going to get into different types of loans, though. But you could start the highlighting right now. Just copy notes. Highlights will be explained on the coming slides. Okay, just highlight the notes here. I'll just explain it because I obviously have a written out definition explaining them a little bit clearer on the next slide. And if you're having trouble reading my chicken scratch here on what it says, I'll read it to you aloud. It says loans to seniors with at least 60 to 70% equity. A first loan, not a second.
I got it.
You got all the other highlights too? Everybody get it?
Yes.
Okay, so the purchase money mortgage. Read it backwards. What is it? It's mortgage money to purchase. It is any loan used to buy real estate is known as a purchase money mortgage. Instead of being a particular loan, it is a whole category of loans. Purchase money mortgage is any loan used to buy real estate. Even seller financing is sometimes referred to as a purchase money mortgage. It's mortgage money to purchase, even if that money is coming from the seller. A reverse mortgage, well, it does the reverse of what a regular mortgage loan does, where you make monthly mortgage payments to the lender. Reverse mortgage, the lender is making payments to the borrower who's already a homeowner when they're 62 years of age or older and they have a lot of equity, 60 to 70% of equity built into the property. It will be a first loan and not a second loan on the property. Because the lender, when you go get a reverse mortgage, even if you still have a balance and you have a current mortgage loan on the property, they will pay it off. The new lender will pay off any existing loans. And then what they do is they start paying you out the equity that you have in your property by paying you monthly mortgage payments. They'll be paying them out in the form of equity checks. They'll pay it to the senior. Why? Because it's a way that the senior can live out their golden years in dignity and have an income that is supplemental to their Social Security check. Because just in case you didn't know, you can't live off Social Security. It's not that much money. Okay. Now they greatly increased Social Security benefits over the years, but way back then, it was really, really, really low. You'd be lucky if you could buy your medication alone versus food, with Social Security. They really did increase those benefit amounts, even though the contributions to the Social Security fund has not been increased. So it's you hear some politicians talking about Social Security as being a Ponzi scheme, and you always hear other politicians on TV saying, "Yeah, you're going to take away your Social Security benefits." The ones that everybody relies on. One thing you got to realize is at some point this system will go bankrupt. So unless both the Republicans and the Democrats get on the same board about how they're going to manage this, the people who are currently contributing to Social Security are not going to get any payouts from it, because by the time you're old enough to, the system is going to be bankrupt. They pay out more money than it takes in. It's a matter of, it's common sense. But there's a lot of ignorant people out there that don't pay attention to this stuff. They just listen to the pundits on the news and the politicians that say, these are the politicians who you should vote against. They're not going to take away your very benefits that the seniors rely on. Now, they could care less about the seniors, because if they did, they would sit down with the other side and have a conversation about and put together a plan how we're going to deal with this issue. Okay. Now, I personally think that if you got enough money to pay for housing and food and all that stuff for illegal aliens to come into the country and pay for them, then there should be no homeless people in the United States that are citizens. There should be no homeless veterans out on the street, and our seniors should be well taken care of. Call me silly for that, but that's just my view on it. But anyway, these reverse mortgages make it available for those who are not getting not just the Social Security, because that's not enough for anybody to live on, but those who are getting pensions because they were formerly government workers, or in a government pension program, like teachers. Teachers, they get when they retire, they get their almost the full pay that they were making when they were working for the rest of their lives. Okay. Most people don't get paid like that. Most people, you got a job and you're getting a check, and when you retire and you no longer work, you get nothing from that job anymore. So you better have savings saved up, or you better have something in like a retirement plan, like a 401k or something, because you're not going to be getting regular paychecks or even a portion of your regular paycheck that you used to get when you were working. These are the benefits that people talk about. And they're like, well, you don't want teachers to have their benefits and all that. It's like, well, most people don't get that. Where's that money coming from? Taxpayers. Okay. And politicians got no problem saying, hey, we'll give you all the money you want as long as your union votes for us, convinces all of its members to vote for us. We'll continue making sure you get all that. So most people do not get this. And because they don't got that benefit, how are you going to live out your golden years when you're of retirement age? Well, hopefully you own a house and you've been paying down that mortgage over the years and it's almost paid off and you got a lot of equity in it, at least 60 to 70% equity. Now you could draw from that by getting a reverse mortgage where the lender will make small monthly mortgage payments to you instead of you making those payments to them. Okay, so it's the reverse of what's normal. That's why they call it a reverse mortgage. Make sense? This was a problem years ago. That's why this first came out in the 1980s. Ronald Reagan, when he was president, he passed this into law that allowed lenders to provide this. Because back then, they didn't have a lot of the benefits that we have right now. You know, like discount drug programs. Today, you don't even ask for it. How many people here get in the mail on a regular basis, like those discount drug card programs, get 70 to 90% off your prescription drugs, right? It's not even insurance. It's just like a discounted drug program where you can get discounts on drugs when you go to for prescription drugs, right? Everybody sees those, right? You get them in the mail, right? You didn't even ask for it. You got it sent to you by companies, right? So what are those companies getting out of it? You ever wonder? They actually get paid by the drug companies for marketing their drugs. So basically you could try to buy the drugs through their program. Okay. Even though it's at a discounted rate, they're basically just drug pushers, and in exchange they're getting paid a fee, even though it's a benefit for you because you're getting those drugs cheaper. All right. They get paid by the drug companies. Now, back in the day, nothing like that was ever available. Senior citizens, they had to be like, oh my God, I got to check my budget. Can I afford to buy the medicine that I need to keep me alive, or do I buy food? That's a tough decision to make because you need both to get by, but the medicine is without a doubt you need it. I remember when I was a kid seeing a bunch of these news clips, and it was kind of heart-wrenching, even as a child, watching it on the news, where I remember a reporter interviewing this bunch of seniors, and they asked one senior, they're like, well, how do you get by just living off Social Security benefits if you don't have a pension from your old job or anything like that? How do you get by? How do you live? And they're like, well, it's tough. Some months we got to see, do we got to buy the medicine that we need to keeps us alive, or do we eat food? And the one lady, she was sitting there petting her cat, and then they show her opening the cat food and feeding the cat. And they're like, well, we stock up on this, I mean, it's affordable with the coupons and everything. And I figure if it's nutritious enough to keep my pet alive, they're eating cat food. How sad is that? How sad is that? That's heart-wrenching, So since then, many other programs came out. There was a guy named Montel Williams, used to be a talk show host, okay? He was a Marine as well, and I guess he saw those same commercials. It was kind of heart-wrenching, but he has celebrity, and he had some pull now. So he started negotiating. He took it on himself to start negotiating with drug companies to come up with ideas on how to give discounted or free medicines to poor people and seniors so that they can live and get by. And today we see now you're getting all of these discount drug program stuff. That's all stems from the beginning of what he did, because there's no programs like that. You either paid for the expensive medicine or you die, So that's pretty good program. Plus now we also have these SNAP programs, or they may rename them EBT programs, to get food available. If you're low income, they give you these, cards where you could get food benefits, and you go to the store and such, right? All these programs may not have been available back then. They are now. So there's a lot of benefits today, but this reverse mortgage program, that's where it stemmed from because that stuff was not available to the seniors back then and still may be useful to people today. Because the senior gets this reverse mortgage where they get a monthly payment of their equity sent to them so that they could have that little extra money that they could use for anything, to go on vacation, to pay important bills, to do whatever it is that they want to do, right? And once they get paid out all that equity or whatever, they never have to pay this loan back unless they sell the house and move or they die. Now, I've had some people in my class say, well, what, they can't leave the property to their kids? Sure, they can. Their kids would just have to pay back the bank all the money that the bank paid out in equity to the senior. I mean, where were you when your parent was starving and they needed to take out a reverse mortgage in order to get by? Were you there helping? No, but now you got the handout that you're like, I can't inherit the house. Where are your priorities? Take care of the parents, for crying out loud. They were wiping your butt when you were a kid. Do you think that was a big joy? Right? Now it's your turn. All right. So uh, that explains the reverse mortgage in a nutshell there. So the mortgagee, that's the lender, makes small monthly payments to the mortgagor, building up debt. That could actually even, the way that statement is worded there, I could see that even being an exam question. What kind of loan, which would best describe the mortgagee making small monthly payments to the mortgagor building up debt? Reverse mortgage. That's exactly what a reverse mortgage does, right? So the senior does not need to pay back that loan until they sell the home or die. Now, when the senior dies or sells the home, the lender is paid back any money that they paid that may have been on an existing loan that was outstanding still, any equity that was paid out, plus the little bit of interest that they were charging. That's why they're in it, right? To make money. So the interest. And so if somebody wants to inherit that home, man, sure, you can get the home. You just got to pay back the money that was paid out. I'm sure you'll still have equity in there. These are just a bunch of commercials showing what reverse mortgages are. I think I did a pretty good job explaining it right now. So what I'm going to do is I'm just going to skip these right now, seeing that we're behind already. So let me skip all these. I got like 4 of them here. There we go. We got past them all. Wow, that was quick. So shared equity mortgage, page 290. That's the 3rd paragraph down, page 290. Under a shared equity mortgage, okay, let's highlight these. Once again, just highlight these. I have explanations on the coming page. And when you get to this point, if you can't read my chicken scratch, ask me and I will read it to you. All right. I should actually type it in there. That would probably make it a lot easier so you don't have trouble reading my chicken scratch.
I got it.
Woo. There you go. I'll cover that up. Listing loan. Yeah. Oh, what's better? And you could probably read it. Maybe. Increase the font size. There we go. Existing loan doesn't have an alienation clause. Now you don't have to struggle to read my chicken scratch. All right. So, home equity loan, what is that? It's kind of like the senior's reverse mortgage, except you do have to start paying it back right away. Anybody can take this too. You don't need to be 62 years of age or older. If you have a lot of equity in your home, you could take out a second loan. It will be a second loan, unlike the reverse mortgage, which is a first loan. You can take out a second loan on your property against the equity that you have built up in it so that you could use that on whatever. However, remember, because of the rule that President Trump put in place, the interest on that loan is not tax deductible unless you use that money to put back into your house to do improvements, for example, instead of just using it to go on vacation or buy a car or whatever, because then people end up abandoning the house or whatever and say, oh, my house doesn't want that anymore. I'm not paying it back. But in the meantime, you already took that money out and you reap the rewards for it, using it as your own private little piggy bank. Right? And now you don't want to pay it back. All right, so home equity does not pay off any current mortgage. It's a second mortgage. Equity is paid as a lump sum in or a line of credit. Okay, it's a line of credit. It's called a HELOC, home equity line of credit. So equity is paid as a lump sum or line of credit, a HELOC loan. So borrowers must start paying it back right away. A bridge loan A bridge loan is when the buyer buying a home before selling the current one. We as real estate agents, if that's a situation, we usually try to coincide closings within 30 days so the buyer doesn't have to make mortgage payments on two different properties, two different homes, which many people can't afford to do. So if that's not possible for us to do, when getting a bridge loan, when buying a home before selling the current one, a short-term financing may be available to make payments on both homes until the current one is sold. That's what a bridge loan is, to bridge the gap of time in the interim until you sell your existing home so that you could swing the payment. That's why they refer to a bridge loan sometimes as a interim financing or a swing loan, which we'll see on the next slide, that definition right here. It's an interest-only loan, a straight loan for short term, usually not more than 6 months, used when a homeowner must buy a new home before closing on their sale of their existing one. It allows them to bridge the gap so that they can swing the payment in the interim until they close on the sale. That's why it goes by the name bridge, swing loan, or interim financing. It's used when the seller buyer, because they're selling one home and buying the other, so that's why they're a seller buyer, cannot afford making payments on two home loans. This temporary financing will help. Let me go back to that previous slide. So the shared equity loan, what is that? Remember I told you it's against my religion to pay interest? Some people, it's against their religion, devout Jews, like maybe Hasidic Jews or Muslims. It may be against their religion to pay interest. So how do they get loans to buy real estate when it's against your religion to pay interest? Well, they get it from an investor who will then become a silent partner, like a co-owner in the property with you. So they'll give you an 0% interest loan that you do need to make payments on to pay back. But the person who lent you that money to buy that home is now your partner, like it or not. And when you go to sell the house eventually, they're going to share in the rewards of the increase in value. They're going to split that with you. So that's the juice that's in it for them that's worth the squeeze. Okay. So that's why they call it shared equity. As the equity builds up, they share in the equity when you eventually sell the property. Okay. A package mortgage, it's a package deal. It includes a loan to buy real estate and chattel. This is often used to buy like new fully furnished condos, or ones that include the washer and dryer and refrigerator and all kinds of other appliances that are considered chattel. What is chattel? Tangible personal property. So a package mortgage is a loan used to finance the purchase of real estate and chattel. That's tangible personal property. That's it. A blanket mortgage covers blanket cover. A blanket mortgage covers more than one loan. So it covers the financing of subdivision developments, perhaps small ones. It contains sort of a modified alienation clause. Remember, an alienation clause prevents you from selling the property without paying off the loan, so it's not assumable by anybody else. So a blanket mortgage contains I'll call it a modified alienation clause. It's actually called a partial release clause that allows the developer to sell off one lot off of a larger one without having to pay back the entire loan in one shot. They only pay it off in bits and pieces as they sell off smaller parts of the smaller lots off of the larger one. Make sense? So here's an image of that. So if you use that loan to buy one piece of property, but now you subdivide it into 6, as you sell off one lot off of the larger one, you only need to pay back 1/6 of the loan, and so on and so forth. Okay. That's a blanket mortgage. Has the partial release clause that allows that. Then we have a wraparound mortgage. What happens if you have a loan that does not have an alienation clause? Can you sell the property without paying it off? What is an alienation clause? It says that when you sell the property, it's also known as the due on sale clause. It means you have to pay it back, so that any future buyers do not just assume your existing mortgage loan, especially if it's at a lower interest rate. They want that next buyer to get their own loan, right? So a wraparound mortgage is a type of loan that does not have an alienation clause in it. So technically, if it doesn't have an alienation clause, which restricts you, which requires you to pay back the loan in full if you sell the property or transfer the ownership, I could sell the property or transfer the ownership without paying off the loan in full, as long as I continue making my monthly mortgage payments. So how about this? I'm the property. I'm going to sell you my property. I'm going to offer you seller financing. That's another thing. Instead of just taking over my loan, I'm going to give you a new loan. Maybe maybe a point or two higher than what I'm paying on my loan. I'm going to make a lot of money off you too, because lending, you can make money. Especially if the lender doesn't have an alienation clause, right? So A wraparound mortgage is where you have one loan. This pen symbolizes, let me see if get you off the screen. This symbolizes the loan that I have on my property that I have to pay that does not have an alienation clause in it. So I could sell you my property as long as I continue making payments on this, it doesn't affect the property or the lender, right? And then I'm going to give you another loan that's maybe 1% higher interest than what I'm paying on mine. My loan I give to you wraps around the existing one without ever touching it. It never disturbs the underlying financing. One loan wraps around the other. I guess that's the way to describe it, as a wraparound, but it's basically you have two loans on a property. They have nothing to do with each other. I got a loan from my bank that I pay, didn't require me to pay it off, didn't have a due on sale clause in it, the alienation clause, that required me to pay it off when I sell it to you. So I'm going to give you a loan from seller financing so that you'll make mortgage payments to me. And I just make sure the interest is a little bit higher than what I got to pay on mine. So I'm making enough money to pay back this loan plus earning interest off of you. Okay. That's what that is. And I got a full explanation here if you should need that. That is much clearer than what the book writes. If you want to snap a picture of my explanation of wraparound mortgage. Oh, but I do have a note here too as advice, which also definitely, absolutely is not in the book. I don't think. Well, they mentioned something about it. They put a little blurb in there about it. It's a good idea for the buyer using such financing to put a contract in place that would allow them to communicate directly with the seller's lender. In the event that they stop making their mortgage payment, the buyer could communicate directly with the seller's lender to make the mortgage payments, because they could still get foreclosed on because they have the primary responsibility to pay that loan. And if they don't, and you got the seller financing, they got the financing from the bank. If they don't make the payment to the bank can foreclose. So if you're getting a wraparound mortgage, it's always advised to get a contract in place that would allow you to communicate directly with the seller's lender to make those payments as an authorized person to talk to the bank. Otherwise, you can lose your interest in that property if you get foreclosed on because he didn't make his payments. Maybe he dies. Something happens. I don't know. All right. So an open-end mortgage is just what it sounds like. It's open. It never actually closes. So as you pay it down that loan, you can always draw back on it, kind of like a home equity line of credit, right? Without actually applying for a loan, because it never closed. However, the lender would have to agree to have that open-ended mortgage for you to be able to do that. They don't have to agree to it. All right. Construction loan is a first loan, not a second, because construction loan is to construct, to make new where there is nothing. It's not a rehabilitation loan. It is a construction loan. Now, if you were to read this whole paragraph, it starts talking about rehabilitation as well. But that's generally a different type of loan. So construction loan is a first loan. If it was a rehab loan, well, that would be a second loan. But construction is to make new. When you are making new, that is a first loan and not a second. So on exams, you may get a question, which one of these loans, and they'll give you a list of loans, and they'll say, which one of these is an example of a first loan and not a second? Or which one of these is a second loan? Which one of these is a second loan? Purchase money mortgage, reverse mortgage, home equity loan, or a construction loan. Which one is the second loan? And
Home
not,
equity?
huh? Yeah, sure, I'll
Home
repeat.
equity?
Yeah, it is the home equity loan. It's the home equity loan. Because you're taking a second loan out against the equity that you have in the property. Correct. And even though the reverse mortgage does that for the senior, there are no other loans on the property because the reverse mortgage company will pay it off. All right, they're just paying out the equity, but it is the only loan on the property. Yes. All right, so I wrote here a first loan, not a second. That's what my chicken scratch says. So under a construction loan, the lender disperses the loan proceeds while the construction is being constructed. So just like an FHA 203K, which is a rehab loan, this is a construction loan. The way that these loans work is they don't just give a lump sum of money to you, the borrower, and hope you go and build the house, which is going to serve as collateral for that loan, right? Because you may be tempted to, hit up Atlantic City and try to double that money. So what the lender's going to do is they're going to want you to get a contractor who's going to supply the labor and the materials up front. They'll do the work in phases. When phase one of the construction is done, the lender will send out an appraiser to confirm that all the things that we have listed that are part of phase one of the construction have been completed successfully. And now the lender will disperse those funds to the contractor for the labor and the materials. Those contractors usually have accounts with suppliers, so they don't have to pay up front. Like you go to Home Depot, you buy something, you got to pay for it right there. They have accounts, contractor accounts, where they don't have to pay this until they get the money from the lenders, and then the lenders would, and then they would pay. Okay, as the work gets done in different stages or phases. All right. All right. Now those are done with different types of loans. Now we're just going to talk about different types of buyer-seller arrangements. There's something called a sale leaseback. Just close your eyes for a minute and think of the words sale leaseback. And tell me what you think it is. Sale leaseback. I'm selling you my property, and then I'm going to lease it back from you. That's exactly what it is. Don't overthink it. Sale leaseback. Now, this is usually with commercial real estate. Maybe a business owner needs to raise revenue because they need to upgrade all of their equipment and machinery or whatever. Or they need money just for operating expenses, maybe to expand the business, maybe to do marketing campaigns or whatever it is. For whatever reason, they need the money. They don't need to take out a loan. They're sitting on a boatload of money, the equity that's built into the property they already own. So what they could do is they could put the property up for sale to an investor who will buy it and then rent it back to them. Now, that business owner has a lot of say in who they sell it to. So therefore, they have some influence on how much they're going to rent it back for. So you can be pretty sure they're going to get a very favorable long-term lease. But it'll still be enough juice in it that's worth the squeeze for that investor to buy it. Right? So that's the purpose of a sale leaseback. So a business owner can get that working capital to run their business, upgrade machinery or equipment or what have you, or expand the business. And then they're going to lease it back from the new owner. Here, what's a way that we could say this? The mortgagor becomes the lessee. What kind of situation does the mortgagor become the lessee? Well, if you're a mortgagor, you're the buyer. That means that you own the property. And if you become the lessee, a tenant, that means that you sold the property and then are leasing it back. Sale lease back. Hey, there we go. I've seen that as a question on exams sometimes. What kind of situation does the mortgagor become the lessee? Sale leaseback. But for that, you need to know who the players are. Who is a mortgagor? Come on. I know you're hearing my annoying voice in your head singing. The mortgagor. Or see, you got it like that. You don't even need to think about it. It's stuck in your head. Why would it be used? Well, I already explained that. Okay, so let's just highlight sale leaseback, sometimes used as a means of financing. The buyer becomes the lessor, and the original owner becomes the lessee. Damn, this is a long chapter. Okay, I don't think we're finishing it right this second. So if you guys got that highlight down, I think it's time for us to break for lunch. And here's the explanation of seller financing, land contract, lease option, lease purchase. We're almost done, but it's going to take more time. I don't want to take that much time out of your lunch. You need to have the break so you can let your brains rest a little bit. So I'm going to pause this recording. All right, so continuing here, chapter 15, seller financing. Your typical seller financing works like this. It works just like when you get the financing from a bank or any other lender. You're going to be making your monthly mortgage payments to the seller. They're going to give you the deed right away. It's the way it typically works. And then you have a land contract, which is also a type of seller financing, except the seller does not give the deed right away to the buyer until they paid off the full amount owed. That's the distinguishing factor there between the two of these. They're both seller financing, but typical seller financing, the seller gives the deed to the buyer makes mortgage payments to the seller. If they start defaulting on their payments, the seller, who is now their lender, would need to foreclose on them. With a land contract, the seller doesn't need to do that when they offer this kind of financing. When they close on the transaction, the buyer, basically it's renting to own. So that's why they also refer to it as an installment sales contract. They're making payments in installments and waiting for the deed. The seller does not turn over the deed until the full amount owed is paid. So the buyer is not the owner yet, but they do have a financial interest towards the ownership called equitable title. And make sure you don't confuse that with the land contract with a ground lease, because a ground lease is where you're actually renting the land and then constructing a building on that land. Then we have with a lease with an option to buy. We cannot prepare those contracts because their option agreements can only be prepared by attorneys, if you recall. Then we have lease purchase contracts where a tenant is leasing and then they're definitely going to buy. All right. What other kinds of contracts? So that's a bilateral contract because both parties are required to do so. So here's just the things, land contract, also known as a contract for deed or installment contract, is a type of seller financing. We went over it in chapter 11, so I'm just giving you the cross reference here. Chapter 11, page 220. And then these are just the other seller-buyer arrangements: seller financing, land contracts, lease options, sale leasebacks. All right, something new. We're going to switch it up now. you should probably have some of this stuff highlighted already too, right? In your books pertaining to Regulation Z. Yeah.
Yes, yes.
So the Truth in Lending Act is implemented by Regulation Z. So Truth in Lending Act is implemented by Regulation Z. It requires truth in advertising when offering lending, when talking about offering financing of some sort. All right, so it requires, let's see, it does not apply to cash transactions or business or commercial loans. Regulation Z requires the borrower be fully informed about all their financing charges. Now, the rules do not apply to home equity lines of credit, reverse mortgages, land loans that are secured by movable dwellings, mobile homes, etc. Remember, Regulation Z is dealing with truth in advertising when offering financing in an ad. And it applies to all kinds of financing, not just for real estate. We're talking about real estate because that's what this class is about, right? So the TRID requires the Consumer Financial Protection Bureau's booklet, the Your Home Loan Toolkit, to be given to the consumer by the lender within 3 business days of their completed loan application. You guys recall when a loan application is considered complete? It's when the aliens have landed, right? All the information from aliens was provided to the lender. And then and only then can they start charging fees for things like credit reports and application fees, etc. So the application is considered complete when they provided all the information of aliens, the address of the property, the loan amount requested, their incomes, estimated property value through an appraisal, the names of the borrowers and their social security numbers. So at the beginning of the transaction, the lender must also provide to the borrower within 3 business days their loan estimate of what the expenses, what the estimated closing costs are going to be. They do that at the beginning of the transaction. So the same time where they give that the Your Home Loan Toolkit, they also give the loan estimate. Now, at the end of the transaction, they give the CD, the closing disclosure, which has all the actual closing expenses. And there must be at least 7 days between the time the loan estimate is giving and the closing. Now, the loan estimate's given right at the beginning of the transaction when you're just applying for the loan. You may be thinking, of course, there's going to be at least 7 days, right? No, not necessarily, because there are certain things that could trigger the lender to have to give a new loan estimate to the consumer if there's certain changes in their loan products, their job situation, and some other things that could trigger the reissuance of a loan estimate. So if that is the case, there still needs to be at least 7 days between the time the loan estimate is given and the time the closing occurs. So what is Regulation Z? It implements the Truth in Lending Act when talking about financing in an ad. It requires the lenders to inform consumers of the true cost of obtaining credit. It allows consumers to compare loan costs of various lenders and avoid the uninformed use of credit. It requires full disclosure and truth in advertising when talking about financing in an ad when they use certain triggering terms. It does not apply to commercial loans, cash purchases, home equity lines of credit, reverse mortgages, land loans secured by movable dwellings, And it applies to all kinds of financing. Even when you see them selling pots and pans online, if they're offering payment plans or down payment amounts or what have you, well, those would be some of the triggering terms that would require full disclosure and truth in advertising when talking about financing in an ad. So, one of the things they would have to disclose is the APR. The interest rate and the APR are two different things. The APR takes into consideration all the one-time non-reoccurring expenses associated with getting the financing, like an appraisal or an application fee. These fees are not reoccurring, so they're not factored into the interest rate. But if you were to factor them into the interest rate as a cost of getting the financing, which they are, that would be called the APR. APR stands for annual percentage rate. So if you factor in all those one-time non-reoccurring fees into the cost of getting the loan over the life of the loan, and then figure out how much that would change the interest rate annually, that would be called the APR. It's always a smidgen higher than the advertised interest rate. Any creditor that offers credit more than 25 times a year, or more than 5 times if real estate is the security, then they have to follow Regulation Z. And here is that slide I put together for you. I showed it to you in a much, much earlier chapter, but it's a great note. If you did not ever take a picture of it or screenshot, I suggest you do it now. This is a great summary of everything you need to know about Regulation Z. Regulation Z is a federal law. It implements TILA, the Truth in Lending Act. It requires full disclosure when talking about financing in an advertisement if certain triggering terms are used. Now, what are those triggering terms? Well, they're words used in an ad that would require full disclosure of financing terms and a qualifying statement to avoid indiscriminately promising financing to everyone who sees the ad. When offering financing, you have to discriminate. You have to use a qualifying term to those who qualify or to a qualified buyer, so that any numbskull who sees the ad doesn't think, oh, I could buy this house, I could buy this car, I could buy whatever it is that they're selling, when they may not be able to qualify. So you have to say to those who qualify or to a qualified buyer, to try to narrow it down a little bit here, to discriminate who can actually get it. And then and that's only when certain triggering terms are used in an ad. Those triggering terms would be if you mention in the ad an interest rate, a payment amount, the down payment amount if one is required, or the term, the number of payments or years of payments. Then you have to say to those who qualify or to a qualified buyer and disclose the APR, the down payment amount if one is required, and the term. And if you do not do this, penalties for violating an administrative order of Regulation Z are $10,000 per day that the violation continues, plus attorney fees, and willful violations, a misdemeanor, punishable by $5,000 fine and up to a year in prison. You have to understand Regulation Z, at least what it does. On exams, you'll get questions about it. You may need to know some of the details about it, or they may give you the details and ask you what law regulates advertising that talks about financing. It's Regulation Z. So now let's highlight these things. Do you guys have this already highlighted and these things? Because we went over them earlier, or no?
Yes, we have that.
You have that already? Okay. And this, right? You got that already? And this, you got that too? And ECOA. This has to deal with, I think we discussed this in chapter 4. ECOA has to deal with, it's a law that was passed when women were discriminated against because, she's the little missus of the house and the moneymaker was the husband, right? So, you go in to buy a car or get a loan for something or to rent an apartment or to buy a house to get a mortgage. The people would talk down to the women. They'd be like, "Okay, honey, why don't you just send your husband over and let the men talk about it?" So women were discriminated against in the past. When it came to the finances and such. So they passed this law, ECOA, the Equal Credit Opportunity Act, to protect women to be able to obtain financing and not be discriminated against. Um, I mean, it covers all protected classes, but it was originally created to protect women who were denied loans because their sex, assuming they may not work outside the home. So this prohibits discrimination on the basis of race and color, religion, national origin, sex, marital status, age, dependence on public assistance, um, a lot of factors like that. Now, if you use tenant screening or grading reports instead, may be a good option. However, due to political changes in the law, that criminals are now protected class under the Fair Chance and Housing Act, even though they try explaining it by saying, oh, this does not make criminals a protected class. It in fact does, because it tries to claim that the criminal justice system is racist, and therefore, if you're relying on criminal background checks, then you therefore are being racist because there's more people of color in prison than there are of those who are not. So it's kind of a leap. It is one of these ridiculous political arguments that the argument itself is racist. But either way, we went over that in chapter 4, talking about the Fair Chance and Housing Act. But either way, the Equal Credit Opportunity Act, this is why when you ever apply for a credit card, a loan for a car, or for a house, or whatever it is, if you're ever denied credit, the lender who denied you the credit, or the one offering the financing who denied you that credit, they're required by law to send you explanation in the mail within a short period of time afterwards. I'm not exactly sure about that time frame. They're required to send you a letter in the mail explaining to you why exactly you were denied credit, just to make sure that it's not because of their protected class. So the Real Estate Settlement Procedures Act, RESPA, was created to ensure that the buyer and seller in residential real estate transactions involving new first mortgage loans have knowledge of all the settlement costs down to the penny. So anybody getting paid in a real estate transaction, it must be disclosed on that RESPA settlement statement. It was formerly called the HUD-1 RESPA settlement statement. But when President Obama created the CFPB, they took a lot of those statements and renamed them, maybe even changed information that was required to be in them. and now it is not called the HUD-1, it is called the CD. So the CD is now required. The HUD-1 can be used on certain transactions that do not require the CD. So the CD is the closing disclosure that accounts for every penny in the real estate transaction for all the settlement costs. Okay, it must be given to the consumer at least 3 days before the closing. So at the beginning of the transaction, an estimate of those closing costs is given on the loan estimate. The old document was the good faith estimate, the GFE, which has been replaced by the LE, the loan estimate. Within 3 days of the consumer completing the loan application by providing all the information that's required of aliens. Now, in certain situations where a new loan estimate has to be reissued, that would trigger an additional 3-day waiting period, and there has to also be at least 7 business days between the time the LE is issued and the time the closing occurs. You need to know these time frames. I got them all right here on this one slide. I would suggest you snap a picture of this slide. You need to know what the Real Estate Settlement Procedure Act is and what it does. You need to know what the CD is and what document it replaced and when it needs to be given, at least 3 days before the closing. Actually, I should put that in here. I should add that here in that slide. So what did I say? Trigger an additional 3-day waiting period before. There has to be at least 7 days between the time the LE is issued and the CD, the closing disclosure, is given, which contains all the actual closing costs, and provided at least 3 days before closing. Now that's perfecto. All right. Everybody good? Once again, another explanation of the time frames and what these documents are. RESPA, Real Estate Settlement Procedures Act, federal law to ensure the buyer and seller in residential real estate transactions involving new first mortgage loans are aware of all the settlement costs. The parties in the transaction must have knowledge of all the settlement costs down to the penny. It does not apply to cash transactions, commercial loans, mobile homes, or reverse mortgages or HELOCs. It's illegal for anyone, it's against federal law for anyone to get paid in a real estate transaction if it's not disclosed on the CD. The CD is the new RESPA settlement statement called the CD, the closing disclosure, formerly called the RESPA HUD-1. The LE, the loan estimate, is given at the beginning of the transaction. It replaces the good faith estimate, the GFE. It's an estimate of the loan cost. You could find all the times that the LE is mentioned on page 294 and 299. There's the cross references. I see I got page numbers next to all these. It must be given within 3 days of the completed loan application, aliens. That's discussed on this page. There has to be 7 days between the time the LE is issued and the closing. And certain changes may require reissuing an LE and triggering an additional 3-day waiting period. Now, what would trigger that 3-day additional waiting period? Well, that is discussed on page 299, which we're going to be getting to shortly. The CD, the closing disclosure, is an accounting of all the final actual settlement costs, and it must be provided at least 3 days before the closing. The CD replaces the HUD-1. So you guys need to know what the old document was what the new document that replaces it is called, and the time frames in which these documents need to be given to the consumer. So this is what you need to know. The name of the old document, what the new document is that replaced it, and the time frames it needs to be given. Okay. And so you got a snapshot of that right here on this slide. It's a good explanation. It's a good slide to take a picture of.
I'm making notes from the slides you provide in the class study material.
Yeah, I mean, once again, you have access to all these slides too, that you could download them and just snag which ones. But as we're going over, it's not a bad idea to snap a picture of it. You could always find them in the slideshows later on and get the nice information, copy it and paste it into a Word document or something, you know. But I have it all right here for you, and as well as here. You know, it's the same information on this slide as is on this one. You know, it's just we had the highlighted here and then my explanation here with the time frames and everything, and when the documents need to be given. Now, we don't give out these documents. This is the lender that does, and the attorneys, right? The loan estimate, that's the lender that gives that. They replace the good faith estimate. The CD, that's the lender once again. But the who prepares these closing documents? It could be a settlement agent, which would be either a title company or the attorney usually, because they're hashing out the final numbers. All right, so TRID, that stands for the reason I drink. No, I'm just kidding. TRID is the TILA-RESPA integrated disclosure, and the CFPB merged and modified existing forms HUD created. Lenders are responsible for delivery of documents within these time frames, the ones that we just went over on the previous slide. That is TRID, the TILA-RESPA integrated disclosure. Remember, I told you President Obama created the CFPB, the Consumer Financial Protection Bureau, and they took over a lot of these forms and disclosures that are required to be given to consumers. That HUD used to have the responsibility. HUD created those and created the timelines and disclosure timeframes that they need to be given. When the CFPB came about, they took over a lot of those duties and just renamed a lot of the forms or reformatted them, trying to justify their existence. And as a result, now you studying for this exam, you need to know what the old form was and what the new form that replaces it is, and what those forms did and when they need to be given, the time frames. So don't blame me. Okay, don't shoot the messenger. I'm just here trying to make it as easy to understand as possible. All right, so TRID, the reason I drink. That's actually a joke the Real Estate Commission gave to us as the instructors. These are the when TRID rules do not apply, when you don't need to use the actual LE or the CD. You could use the old forms on these transactions, the HUD 1 or the good faith estimate you could use on transactions where TRID does not apply. Those home equity lines of credit, mortgages secured by movable dwellings, reverse mortgages, cash transactions, or loans for commercial purposes. And this is page 294 as well. The lender may charge additional fees, such as an application or appraisal fee, only after the consumer indicates an intent to proceed by completing their loan application. Aliens. And this is a little graphic that shows you what aliens means. See, some of the stuff is repeated several times in the book, you know, it's all over. I wish that these books were more compact so it's not repeated over and over and over again. But Okay, here's the loan estimate on the bottom of the same page 294. The loan estimate, the LE, replaces the GFE, the good faith estimate, and it needs to be given at least 3 business days after the completed loan application. It needs to be put in the mail by then, along with the toolkit. The Your Home Loan Toolkit. All right. So when is reissuing the new loan estimate required? Okay. So we got it right here now, which is on page 299. So we could skip a couple pages, go to page 299. This is the situation where reissuing a new loan estimate would be required. Okay. You could highlight it here. You could just highlight this and put a bracket around these things. And I'm going to go back to my previous slide. These are things that would trigger a new loan estimate. Put a bracket around it. And then these are changes that would not trigger any delays or requiring a new loan estimate. Boom, boom, boom. Okay, everybody good? So this is when you need to, this would trigger a new loan estimate. So here, let me put this slide back up here. Where are one of those notes? Okay, so this would trigger the reissuance of the loan estimate. When the consumer requested change in the loan or amount of down payment, the appraisal came in higher or lower than expected. That happens. Changes in borrower's credit score or debit or debts. Here's a tip, a very important tip for you. Geez, I thought I put this someplace that it was highlighted too. You know what? We should highlight it. So, buyer's agents should inform their clients not to make any large purchases, charges, layaways, car leases, or change in employment until after their closing. Why not? Because it could change their debt to income ratio or their ability to qualify for the loan. I can't stress how important it is to discuss this with your clients. I've had clients that even after I discussed this with them, they still did this. So much so, the next slide is going to be a goof video that some real estate agent put together. I figured I'd share it with you to break up the monotony a little bit, where she goofs on some common things that we come across when dealing with buyers. And it's like banging your head against the wall. It's very frustrating for us. So you really should go over this with your clients and stress this before you start shopping for a home. Don't go changing your job. Don't go making any large purchases. Don't go buying any cars or leasing vehicles or buying furniture and putting it on layaway because it still hits your credits report. The lender could not document the borrower's pay, like in overtime, bonuses, tips, and other income, like with bartenders, waitresses, self-employed people, strippers, all kinds of jobs like that would it's a little bit difficult to track. So that could trigger the reissuance of a loan estimate. The cost change for services the borrower cannot shop for. The interest rate changed because the borrower didn't opt for a rate lock or it expired. A prepayment penalty was added. I know I told you guys no prepayment penalties in New Jersey, but that was on loans from institutional lenders. Let's just say it's one from a private lender. So you can still get prepayment penalties in New Jersey if it's not coming from an institutional lender. Loan product was changed, or the APR increased beyond allowable limits. What are those limitations? 1/8% for fixed rate loans, or 1/4% on adjustable rate mortgages. Oh, where's that video? It's probably after this. Okay, so just in wrapping one more time, aliens. Loan applications considered to be complete when all the information of aliens has been provided on page 294. We see that. The loan estimate replaced the GFE, must be given to the consumer within 3 business days of their completed loan application, and there has to be at least 7 days between the closing and the time the LE is issued. A new LE must be reissued if certain changes are made, and this would trigger an additional 3-day waiting period. The Your Home Loan Toolkit explains how to shop for and compare loans. It must be placed in the mail to be delivered to the borrower within 3 business days of the completed loan application. And the CD, the closing disclosure, replaced the HUD-1 RESPA settlement statement, and it must be provided at least 3 days before the closing. So once again, we hear all these time frames that we need to give these documents, right? Or the lender does. What's a business day? Because it keeps talking about so many business days before this or so many business days after that. What's a business day? We're going to clarify things, maybe. There's 2 definitions for a business day. One definition of a business day is any day that the lender is open for business. And the other definition is any calendar day except Sundays and federal legal holidays. Thus, depending on the lender, Saturdays might or might not be considered. So there you go. Clear as mud. It depends is the answer. What's a business day? It depends. That's basically what that all said to me. So let's just write these notes here. Above loan estimate, write LE, because that's what that is. And then just write replaces the GFE, good faith estimate. I know you're doing this for like the umpteenth time already. And then do the highlight. So this way you have the notes that you've been taking a picture of that I wrote also from the book. Because over here, I think they also write here pretty good. They do a good definition here for the loan estimate. There must be at least 7 business days between the delivery of the LE and the closing. The only thing they don't say is what document it replaces. And the CD must be provided to the consumer at least 3 days before the actual closing. The consumer signs the loan.
I got that.
All right, you both good? Seems like we
Yep.
lost the rest of the crew. Well, that's all right. They don't get to watch the humorous videos that I got. Okay, so this lady, I think she's a real estate agent in Canada. But the humor's still there. I'll pause it at a certain time and chime in a little bit to explain like with the lockbox. You know, at one point she's charging this lockbox with a sword and a hammer and all kinds of stuff. These are like the push button lockboxes that are notorious in the wintertime, that when they get a little snow, a little bit of rain, they freeze and you can't open those things worth a damn. You gotta like take a hammer to that thing in order to get it loose.
And Gemma, I've really been thinking about getting into real estate.
Right?
It seems like you've got such a flexible day. You can
Yes.
drive around all the time and make your own schedule.
Right.
It seems like fun and easy.
Jamariquette, bonjour.
I was just wondering, can we see 8 houses tomorrow morning?
Tomorrow morning as on Christmas Day?
I'm not sure if you guys heard what they were saying on the other end of that line there. They were like, yes, we were wondering if we could see 8 houses tomorrow morning. And she was like, tomorrow as in Christmas Day?
Okay, I gotta pull up this address. Oh, come on.
Yeah, come on. We've all been there before. Well, actually, has most of the general public? Maybe not. We go to a lot of different addresses as working in the field. And sometimes these addresses, they don't show up on Google Maps, Yahoo Maps, or any of the other mapping software. It's like the address is non-existent. You can't find a damn thing to get to it. It's like, now how do I get to the address? Where is the property located? Oh, it's frustrating to say the least. So I could feel her frustration when she's like, oh, come on.
Gotta pull up this address. Oh, come on.
Got push button lockbox.
I mean, you get to look at all these amazing houses and everybody's staging right now, right?
In the meantime, her girlfriend's talking about how easy her job is. She's like, yeah, I want to do what you do. It's kind of easy.
Yeah, most of them do. And this is the master bed. I'm sorry, we're not going to see this.
Oh, yeah, and that does happen. That happened to me on multiple occasions where you're going in to show a house and people are doing the nasty in the bedroom. You know, it's like I walk into a house. I don't just walk into a house and use the lockbox. I knock on the door first, and then I say, realtor. I scream through the house, realtor, realtor. I make sure that my presence is known. And if we're going upstairs or downstairs, realtor, hello, you know, and people are like, well, we're already in the house. What are you yelling for? I'm like, because they may not have heard us. There may be somebody in there. I just want to make sure we're not walking on anybody doing any hanky panky, because I've done it on multiple occasions.
I mean, you get to work with people. And I love people. I'm a people person.
Gemma, we have some exciting news. We're pregnant.
So we have to stop looking at 2-bedroom houses and we have to start looking at 4.
But we have the same budget though still.
All your clients have to do is love the house and then they buy it.
Gemma, this house is perfect.
Right?
Yes, totally. But I feel like there's a but.
But we've only seen 87. I think that we should see some more. It needs to be perfect.
So we did it. We found you the
HGTV where they show you 3 houses and they sit there wait for you to pick one of them. Yeah, when you work in the real estate industry, you're showing a lot more than 3 houses, you know.
perfect house. This house is at market value. Okay, so they're asking $648,000.
So let's offer them $400,000.
Yeah.
Okay, guys, we have received the home inspection report. So everything
Awesome.
is good. We can now remove our conditions.
You said if we find something wrong, we could walk away or negotiate with them, right?
Right? What is wrong?
Well, The lights were too bright.
The paint? Mm-mm.
I didn't like the doorknobs.
It's just the atmosphere.
And the windows were kind of dirty.
It's really messing with my feng shui. I get to see.
Now, I tell you what, those things are not reasons to renegotiate or back out of a contract. They're explaining all kinds of cosmetic stuff you saw when you were looking at the house to begin with. The windows are dirty. Wash them when you get them. I mean, that's a silly one. But you didn't like the paint, or there was a stain on the carpet. Once again, those are cosmetic things. Those are not reasons for which you should have saw before. Those are not reasons for renegotiating.
Social media account and all of those happy people. I want to make everybody happy.
Guys, picture! Hey guys, we're happy we just bought a house! Take a picture! Yay, cheers! Cheers!
So that's fine, but that's not a thing.
What
No, thank you.
No, see, that'll be great.
No, thank you.
I mean, it's an easy job, and you get paid so well.
Okay guys, so the process is done. So from now on until closing, make sure that you're not buying any big purchases on credit.
Obviously.
Okay, so no boat, no vacation, no cars.
Come on, Gemma, we're not dumb. Gemma, what do you think of our new car?
Isn't it great?
You paid cash, right?
We got a wicked 1.5% rate.
It doesn't matter if you got a deal on the interest rate, it still hits your debt to income ratio, and now you may not be able to qualify for the loan to get the house. That's why she got that look on her face right now.
Yes, you know what? Honestly, I think you're going to love it. Would you like me to get you my books?
Sure, yeah.
Yes, do that.
Wait, you have to study all this just to sell houses?
I thought it was a cute little video that she put together, going over the issues and how people look at us and how easy our job is. Yet we got to deal with a lot of bullshit. Pardon my French. We have to deal with a lot of BS out there, and some of the things that we come across and the issues we got to deal with. So I thought it was a cute little video I'd like to share with people. All right. And guess what? Hey, that's the end of this chapter 15. So let's do the key terms to review. There are two of them, but before we dive right in, key terms number one, I want you to go to letter J. And at the end of letter J, write usually for one lender. Usually, next to letter J in the key terms 1 for chapter 15. Next to letter J at the end of the line, write usually for one lender. So it says agent who makes real estate loans, usually for one lender.
Usually for?
One lender. One.
Okay, one.
Usually for one lender. So they work for one lender. Then go down, when you're done with that, go down to key terms 2. Letter C, where it says seller financing, put / any loan to buy real estate. Any loan to buy real estate.
Can you repeat that?
Okay, next to letter C in key terms 2. After it says seller financing, put / and write any loan to buy real estate. Any loan to buy real estate. Any loan to buy real estate. Get that?
I got it.
And then next to letter J, under key terms 2, at the end of the line, write TILA, T-I-L-A, TILA, T-I-L-A. By the way, you could see, I am updating all the PowerPoint slideshows in the shared Google Drive right now for you. So I deleted them and I'm replacing them now with the, all the updated ones up to chapter 15, which we did so far. All right. So while it does that, I want to show you it's doing its thing. We could do the key terms to review. Key terms 1, mortgage covering more than one parcel of real estate.
Blanket mortgage.
Yes, 1 is A. A mortgage covering both real and personal property.
Package mortgage.
It's a package deal, that's correct. 13 is B. A cooperative organization for members who save and borrow.
Fannie Mae?
The cooperative organization for members who save and borrow. That would be a
Credit union.
yes, credit union. 3 is C. A privately owned corporation that sets standards and buys mortgages.
Fannie Mae.
That would be Fannie Mae. 4 is D. Federal Home Loan Mortgage Corporation warehouses packages of mortgages originated by member savings and loan associations. Or you could take a
Freddie Mac.
first letter of each one of those words and it spells FHLMC. And what is that the symbol for?
Freddie Mac.
Freddie Mac. 5 is E. Government National Mortgage Association pools mortgages for investors.
Ginnie Mae.
Mae.
What's that?
Ginnie Mae?
Ginnie Mae, correct. 6 is F. Additional financing for homeowner, usually a type of second mortgage.
Home equity loan.
A home equity loan. 7 is G. Loans with interest only, typically for less than 6 months.
Is this similar with like the straight loan? I think.
Well, what do we call
Interim financing, I think.
loans for interest only, typically for less than 6 months? Yeah, interim financing is what they're looking for. They should have a little more of a description there. Well, of like, but I guess they couldn't, well, we can't fit it now because it's too much to write in there, you know. When you're selling one home and buying another, it's also referred to as interim financing. Bridge loan, swing loan, right? Interim financing. 8 is H. So that definition could have been better. A loan higher than those usually bought by the secondary market.
Jumbo loan?
They're jumbo in size. That's correct. Jumbo loan. 9 is I. Agent who makes real estate loans, usually for one lender.
Mortgage banker.
Mortgage banker. 10 is J. Agent who brings together a lender and a borrower for a fee.
Mortgage broker.
Mortgage broker. So they work with it's different than J because they work for with more than one lender. They work with many lenders and investors. So 11 is K. A mortgage that provides possibility for further borrowing.
Open-end mortgage?
Yeah, because it never closes. It's open. So 12 is L. Straight loan for short building period.
Construction loan.
Yes, construction loan. 2 is M. Okay. Lending institution, key terms 2, by the way. Lending institution that makes mortgage loans to the public.
Primary mortgage market.
Correct. 2 is A. Loan not intended for resale in the secondary market.
Portfolio loan.
1 is B. Portfolio loan. Seller financing. Any loan to buy real estate.
Purchase money mortgage.
A purchase money mortgage. 3 is C. Arrangement by which a seller becomes the tenant.
Sale leaseback.
Correct. Sale leaseback. 7 is D. Process of deciding whether to make a specific loan.
Underwriting.
Underwriting. 11 is E. E as in Edward. Words in an ad that require full disclosure of financing conditions. What do we call those words that are in an ad that require
Triggering term.
disclosure?
Triggering term.
Triggering terms. 9 is F. Percentage of income borrower may spend on housing expense. Percentage of income borrower may spend on housing expense.
Qualifying ratio.
Qualifying ratios. 4 is G. Mortgage in which the lender sends regular checks building up debt.
Reverse mortgage.
6 is H. A loan in which investor shares payments and profits.
Shared equity mortgage.
8 is I. Implements the Truth in Lending Act. What implements the Truth in Lending Act?
Regulation Z.
Regulation Z. 5 is J. Regulates consumer loans. What regulates?
Truth in Lending Act.
It's the Truth in Lending Act. 10 is K. Larger loan that does not disturb the underlying financing.
Wraparound mortgage.
12 is L, the wraparound mortgage. Merges the TILA and RESPA disclosures.
Trade.
TRID. Yes, the TILA RESPA integrated disclosure. That's what TRID stands for. 14 is M. Detailed loan cost. Where are all the details of the loan costs specified?
Loan estimate.
In the loan estimate. 15 is N. And required items before the lender can proceed or charge any fees.
Aliens.
Aliens. 13 is aliens. That's when the consumer supplied all the information that's needed and completed the loan application. Okay, so that concludes chapter 15.